Hello, this is Llanes with WealthNet Investments. Today I'm going to talk a little bit about thinking fast and thinking slow. Today I was looking at the grocery store situation, and I noticed that everybody was hoarding toilet paper, meats. It doesn't matter what. There was so many things that were being hoarded. And it got me thinking about how the fact that when someone starts to hoard, it actually can lead to more hoarding. So if you go to the grocery store and you need some hand sanitizer and everybody has taken all the hand sanitizer, then you're like, oh my gosh, I better get some hand sanitizer. Or if you notice that everybody starts taking all the toilet paper, it's like, well, I better get some more toilet paper too and stock up because I may not be able to get toilet paper. So everybody starts hoarding things, and it becomes a cycle. This is happening as well in the stock market, where things are turning into a cycle. So where the thinking doesn't make sense. And there's a long known fact about how we think, and psychologists have known this for a long time, that there's basically two modes of thinking. One is system one thinking, which is thinking fast automatically. It's thinking with little effort. And we can do a lot of things very effectively by using system one thinking, where we can make judgments very quickly. And then there's system two thinking, which is where it requires a lot of attention. It requires a lot of effort and computation. And sometimes with more complex situations, that is what's needed too. And what's happening right now is we have a lot of system one thinking, where people are just making knee-jerk reactions. And we could see that right now with the hoarding of the toilet paper, the hoarding of lots of different products. Even though it's not necessary, this is also happening in the stock market, because what we're starting to see now is indiscriminate selling. And there is selling in even safe instruments like bonds. And people are raising cash for liquidity. And every time that happens, what is the right thing to do? I'm going to be talking a little bit about a model of what I call a model of panic. And probably one of the best models we can think of in recent history would be the 1987 crash. Now, that sounds like a long time ago, but to me that's relatively recent, because that's the last time we've had a very quick, sudden drop, like similar to what we have right now. It is different, but similar. So what I'm going to do is I'm going to compare this model of panic in 1987 to today and talk about what happened, how fast it happened, and where we are today. And then I'm going to bring this down to what should we be doing right now. So what we have right here is a chart of the S&P 500. And if you look at this chart, you could see back in 1987, August 25th of 1987, the stock market measured by the S&P 500 peaked at 337.89. And then over a very quick period of time, over a period of 39 trading days, the market came down to a low of 216.46. That was a 35.93% decline from high to low in the 1987 crash. 39 trading days, down 35%. Now, that was a pretty extensive decline, and that happened very rapidly. So if you compare that to today, if we look at a similar chart to today, what you'll see is that we had a similar type decline, but not as much, but it was very volatile and rapid. So far today, what we're looking at is the market peaked on February 19th, 2020, and the S&P 500 was at 3,393.52. And over a 17 trading day period of time, we went down 26.9% so far. So that was a very quick, in fact, more rapid decline than what we saw in 1987. If you go back to the 1987 chart, what we see is that we had more of a digestion phase up top, where we saw the market kind of digest a little bit and then quickly, rapidly drop. Now we have kind of a just sudden gap. In fact, we saw 3%, 4%, 5%, 6%, 10% moves daily, okay? And that's what we've been seeing daily. And this is kind of a panic selling. We didn't see the panic selling start coming in until much later. Now, of course, this is related to the coronavirus. So there's a lot of uncertainty related to that. Now, the good news is that we've come into this decline for clients already conservative. So we had been pulling back before this. So we didn't have a 26% decline. In fact, our balanced accounts had 12% decline. Even our dynamic growth strategy had a 9.95% decline during this period of time. So many people out there, however, we recognize are being hurt in the marketplace. And so I want to talk a little bit about what this model of panic means to us today, because if we think about this, what was the right thing to do in 1987 when we had this panic? What was the right thing as an investor to do? Well, let's look at what happened afterwards. So we bottomed out in 1987, and then we proceeded to have a 66% gain in the stock market over the next 2 years. So people that sold out during that panic missed an enormous move. Now, that's lesson number one. Lesson number two is that there was a lot of volatility as the market was bottoming. If you look near the lows here, we saw movement that was moving up and down and up and down. There was a lot of false starts. And some people call those sucker moves, where they move up very rapidly and people get sucked in. And I think that's if history is a precedent, that is likely to happen again. Now, we could have a V bottom where it just comes down and then rapidly moves up, and there's no fits and start, no moves that move up that pull people in and then come back down. And normally, if you study market bottoms, what normally happens is you have volatility that really wears people out. And when everybody's wore out, that's when the bottom occurs, and then you have things move higher. So it really pays to be patient. So the thing that we want to do here is we want to not use system one thinking, where we're thinking automatic with little effort, because that is what's going to get people, investors, in trouble. System two is where it requires attention, computation, and effort. That is the way to go about it. And if you look at the market, and that's one of the things that we do, we use a lot of systems. We use processes and checklists to make sure that we're disciplined. And we primarily look at the markets in 3 dimensions. Quality would be the first dimension, which has to do with how knowable are the cash flows, how knowable is the value. And then valuation has more to do with how much am I paying for something relative to what it's worth, based on what we know about cash flows. And then the last would be the technicals, which is a dimension of to what degree is the marketplace recognizing the value, because you can have a situation that appears to be attractive, but if the market doesn't recognize it, it is absolutely worthless because you can't really make money in it. So we are always looking at the supply and demand for the securities themselves to be recognized. So if we back up and we start doing system two thinking, which is what we always strive to do in our business in managing money for clients, is when we look at investments across those dimensions, what we're actually finding is that there is an opportunity to upgrade portfolios for many people. So what I mean by upgrade is that you can buy higher quality companies for better valuations now than many different investments that may be held now. And this is happening because there is indiscriminate selling. And actually that's opportunity. And I had a video that I sent out a couple of weeks ago talking about how we are starting to smell opportunity. Now, given that, we don't really want to call a bottom, because that's very difficult, because when you study the bottoms, like I talked about earlier, we have these movements up and down that can be very tricky. So really, the third lesson is to scale, to not do things all at once, because if you do that, then you may have more errors. So the way to be thinking right now is to actually, first of all, look at where you are right now. Did you reduce exposures before this move, like luckily we did, or are you coming in fully exposed and having a big decline in your portfolio? If you had a big decline in your portfolio, unfortunately, your drawdown is large and it'll be harder to dig out of it. One thing that's really, really important is you want to keep your drawdowns low because it's really pure mathematics. Because if a portfolio goes down by 50%, for example, it has to go up 100% just to break even. So the further you go down, the more you need to go up percentage-wise, and the lower the probability of recovering. So one of our goals is to keep drawdowns reasonable. So all of our strategies have that as a important look. But I want to actually discuss a little bit more about this system two thinking. One of the things that we want to look at is we talked about quality, but this scatter chart in front of me here that you're looking at, it's an earnings yield and dividend yield scatter plot. So what it does is on one axis, which is the x-axis on the bottom here, we have the earnings yield. And earnings yield is simply how much is a company earning relative to what you're paying for it. So if it's earning a yield of 5%, that means earnings is 5% of the current price. Now there's a growth factor that's involved there, and earnings can have a lot of different adjustments that need to be made to them. But if we just look at earnings yield, that gives us a good indication about what you're getting for how much you're paying for it. The other part of the other dimension is the dividend yield, which is how much of those earnings is the company paying out to me as an investor. And when we look at these things, what you can see, this is a scatter plot of some of our top holdings and some of our positions that we are actually looking to enter in now. You could see that there are some relatively attractive investments. I mean, when you've got a long bond that's trading under 1%, when you got a 10-year treasury bond where you can't even earn 1%, that's really not really attractive, especially when you consider there are companies out there that have earnings yields of 8% and that are paying you dividend yields of close to 4%. Now that's way more attractive, right? And I think system two thinking would allow an investor to say, okay, let's be rational about this and let's diversify across those instruments, those investments that have high quality, a lot more knowability in their cash flows, and that are giving us strong dividend yields and strong earnings yields and have good growth and stability in their business, and pay a reasonable price for them, because we're going to come out ahead if we diversify. The probabilities of us doing better than buying the bond market is much, much higher. So system two thinking is the key, and that is the right thing to do. That would be the right way of thinking right now in this marketplace. And I believe that we could have more to the downside, because if you look at the model, if we go to the 1987 model of panic, we had a 10% decline from here, right? It continued to go down. And then we had a lot of chop before then. So the way to do this is to scale, think rationally. So if you're in a situation where you're not sure what to do, give us a call. We'll be glad to take a look at what you're doing and see if what is the best way to optimize the portfolio for your situation. What we're coming in on this as a firm is, if you look at the asset allocation across all of our clients, we're coming in with only less than 40% of our portfolio is in stocks. The vast majority of the portfolio, 60% of our clients' assets across the board, are in defensive type issues: cash, bonds, gold. Very little international equity right now. In fact, we scaled that back now. In fact, if you look at the international market, there are individual securities that have great characteristics. Owning an index is something that we don't really want to do for larger accounts. Our $1 million plus type accounts, $500,000 accounts. You really want to have the diversification into the best names based on our analysis. That's our philosophy. So having this cash gives us the ability to be shopping. So we're on a shopping spree right now. Does that mean we rush in? Absolutely not. We want to scale. But what we're seeing is it's like if you went into a store, like let's say you went into Target, and there was a big sign there that said 30% off all items. And that's kind of what we're in a situation like today. So what would you do if that situation were happening? You went into Target and you had 30% off everything. You'd probably shop a little bit longer, right? And you would go from there. That's what we want to really stress right now. Thinking fast and thinking slow was something. There's a good book by Daniel Kahneman called Thinking Fast and Slow that talks about this. He was a winner of the Nobel Prize in economics, and I think it's really appropriate. So hoarding begets hoarding. System one thinking begets system one thinking, which is meaning quick action. That could lead to more panic, right? We don't really know. Nobody knows. So upgrading the portfolio is the right thing to do right now, and to think rationally. If you're already overexposed in the market and you've had a big drop, that's okay. The best thing to do is think about what to do forward, right? The thing to do forward now is to say, how can I upgrade my portfolio given where we are today? If you are in a situation similar to us where you have a lot of dry powder, now it's time to say, okay, what should I be scaling into? Not being fearful, but scaling our way into it, knowing that over time, if we diversify, that our probabilities of being well ahead of just being fearful in bonds or all in cash, we're likely to be much further ahead 5 years from now, 10 years from now, 20 years from now. So that's my message for today. I hope you guys are doing well. We're doing great over here. We are really working hard looking at what's happening. And for us, it's really not work. It's actually fun. So JP Tremblay and myself were talking about, I was going to try to have him on this video today, but he couldn't make it because he's actually doing some trading right now and doing other things. But we'll hopefully have him on the next video if we can make that happen. Hope you guys are doing well. Enjoy the rest of your day and have a great weekend. Louis Llanes with WealthNet Investments signing off. Bye-bye.